From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It's Wednesday, April 15th, and you're listening to a Wednesday bonus edition of the HPS Macrocast. Tony Fratto here from the Pittsburgh area, sporting a Hall of Famer Rod Woodson jersey today, which, if this was a video cast, you could see it. And my friends, Brendan Walsh and John Fagan, at Markets Policy Partners back in the DC area. So it was supposed to be tax day. No taxes, no income taxes are being collected today unless you want to voluntarily send them in, which you can do. The IRS, I can tell you, would be happy to get it and take them now and lessen the load later on, which is going to double up for them. But it's also smack in the middle of earnings season. In this dynamic environment, looking for any clue on the economy that you can get. We've talked about this last week. I was starting to pay attention to jobless claims. Now we're going to get a sense from earnings, and we're really getting first the big bank earnings rolling out, yesterday and today. What are we learning from bank earnings right now?
So, trying to predict exactly what the earnings per share are going to be for the first quarter, especially for a bank, is almost impossible, especially the big banks too, because the big banks are a combination of, loans, mortgages, small business loans, big business loans, but also the investment bank side of it, and that's trading. So the trading side was actually very good. Volatility creates a decent amount of revenue. So that side of the business was quite good. The lending side of the business, because the first 2 months kind of were semi-normal in the United States, so we're just kind of talking about March where we see the big stress in it. So while we haven't seen actual losses yet, they did have to mark down some of their holdings. It's called mark to market. So if the price of a bond goes down, you have to recognize that in your earnings. But they take reserves for future losses. So they estimate, I have a credit card book, I have a mortgage book. This amount of the people I think are going to probably not pay. So that has been the big story so far. So in the first 2 days, yesterday and today, we've seen JP Morgan, we've seen Citigroup, Bank of America, Wells Fargo, and Goldman Sachs. And all of them took huge revenue allowances in the $5 to $6 billion range. But the kind of big story for the market, while the bank shares haven't done particularly well, the overall market is taking the bank earnings well because their capital, they didn't have to eat into their capital to take these reserves.
Right.
The banks were still somewhat profitable and hold the same amount of capital that was deemed necessary under Dodd-Frank. So what we're having is an earnings crisis for the banks, and that was kind of why the banks sold off yesterday. I think it was a combination of two things. It was really, I think, Wells Fargo. So Wells Fargo on their call said that they were going to take away their net interest margin guidance for 2020. I'm not exactly sure why the market was surprised by that. I can't imagine how anybody could predict what your NIM is going to be for in a pandemic, but it did. But the rest of the market ignored that and was good with the fact that we have a lot of crisis, but it looks like we're going to make this through it without a banking crisis.
And that's a really important.
I think it's go ahead.
Yeah, it's a really important distinction. The distinction between creditworthy and profitable, and certainly
right.
That's when you're talking to regulators, when you're within the four walls of the Treasury. Creditworthiness is obviously the most important thing. You want to have your companies be very profitable, and certainly the two are interlinked to some extent. But the strength of the bank's balance sheets, when you look at the way that credit default swaps, which is the derivatives price, it's basically a market-based gauge of the creditworthiness of a debt issuer, in this case the banks. And if you look how those credit default swaps reacted to the earnings yesterday, they didn't react hardly at all. They look really good. They're about at the best levels we've had since early March. And so the markets are saying, boy, these banks look really, pretty solid on their credit worthiness score. In terms of their profitability outlook, that's really the issue. And so that hits the equities to some extent. From a policymaker perspective, you want the companies to be as profitable as possible, but you need them to be credit worthiness. So as a as a wise man once sang, or very often has sung, you can't always get what you want, but you get what you need in this case, as a policymaker, and certainly anyone with an interest in the stability of the system.
Yeah, and I think the reality is there was some good parts and bad parts of Dodd-Frank, and I think over the last 10 years we've kind of come to an agreement on and fixed some of the things that were a little weak, like the Volcker in terms of market making. But in the end, the Dodd-Frank was about holding more capital. That's the one thing that you can do. Everything else you kind of have to predict or do. These guys are holding probably the proper amount of capital, so you don't want to take a victory lap this early. But that part of the regulatory system, I think, has proven that's what matters.
Yeah, capital and liquidity. I mean, both.
Yep.
I think we've seen for the most part have held up pretty well. There were some problems with liquidity as a general market issue, not necessarily a bank issue. Although the banks, for a period of time, were unable to play their traditional role of liquidity provisioners, and that you could blame on Dodd-Frank.
Yeah.
But overall, the banks themselves are pretty.
And that's why the Fed had to step in to fill that role. So the system wasn't broken, but it's not the most efficient way to run this system to have the Fed throw in, trillions of dollars of liquidity.
Right, exactly. But then from a capital standpoint, as you mentioned, capital standpoint, quality capital, they look pretty good. And I think you're right. I mean, there were definitely things to criticize about Dodd-Frank, but we are seeing these benefits of it as it's being tested, and we'll see what happens, right? I mean, we still have, we have situations where, we are, with loan forbearance on residential mortgage, loan forbearance, say on commercial, market. We don't know if all of the money that is being pumped in is going to be sufficient to pay bills due. And if it isn't, or if people just simply choose to hoard, the money they're getting rather than paying bills, you start to see some deterioration in the credit structure all the way through the financial system. And then whether banks are okay in that situation, we'll find out. But so far, they look like they're in good shape. Yeah.
Though Jamie Dimon had an interesting data point on the call yesterday. So when they went through their book and looked at their clients that have borrowed from them, especially with the credit card, they estimate about 40% of the people that have a loan with JP Morgan are actually making more money now on unemployment claims than they were normally.
Yeah, but the question is though, for them, if you are in that situation where you're relying on unemployment insurance, how confident do you feel about those those bills coming in? Now we know for a fact. I mean, we know that it's subtracting from what would normally be discretionary spending. There is no discretionary spending,
right? Because you can't go outside.
You can't go outside and spend on anything. We hope that they feel comfortable enough that they are going to stay current on rent, utilities, credit cards, auto loans, student loans, those kinds of things. It would be good if they do, and if they understand, they should have confidence that money's going to keep coming in. I think all the signals we're seeing certainly are that it's going to keep coming. So that's good. Well, okay, so we got the banks out of the way. What other big earnings do we have? And again, is any of this giving? I feel like we're we're in a dark room and trying to figure out what this economy looks like.
Yeah.
By with imperfect measures. Earnings are a really imperfect measure for one of the things that we just talked about. They're backward looking, and we also know that the loan provisioning thing is just guess for them as to what it
Right.
is going forward. So any of the earnings that we're looking at give us any clue as to where things are with the economy, GDP, for example.
Well, so Las Vegas Sands reported today, and while that's not the perfect economy, I mean, it just shows you the reality. Their entire business disappeared. You're not allowed to go to a casino, and there's no sports to bet on. So in terms of things that are hardest hit, that's probably the best example I can find.
Yeah, it's really going to be. It's going to be such a patchwork. We saw Johnson & Johnson come out, and they had good. They had they
selling
were
essentials.
Yeah, they were rewarded by investors. We saw United
and
Health Group.
they rose their dividend, so they were confident enough in their their earnings that they raised dividend.
United Health Group was up pre-market last time I looked. They had a good quarter. We're going to see the overall expectation. It's real finger in the wind is for about a 5.5% contraction in earnings for the S&P 500 companies over the first quarter of last year. Mm-hmm. And that is but it's really chunky with big, huge downgrades in industrials, in energy particularly, and these areas. It's and second quarter is supposed to be is expected to be worse, down 10% right now. But again, these are very low visibility numbers, and when we're thinking about company by company, that we're still very early days, and so we don't have enough information to say. But industrial fasteners, Fastenal, they're in everything, and they came out yesterday with pretty good earnings. Right. So it's really going to be hits and misses.
But I would say, so these first 2 days are dominated by the big global financials. Next week we get the regional banks, and I think that will give you a good look into the reality on Main Street throughout America, because those banks just make loans. They're not involved in trading so much and things like that. So what they provide for provisions relatively compared to the big banks will be very enlightening. And also that's where a lot of the small business loans are made, and especially kind of in the middle America. So I think that will be give good insight, especially the guidance that they give on their calls.
Great. Okay. Well, hey, so let's that's there is we're in earnings season, so we're going to see this from a lot of companies, and we know that we're going to begin by saying every number that's not, if you're not in the health or essentials business, the numbers are probably going to be pretty bad. I think we saw New York State manufacturing. I think I just saw a headline on this, down, negative 78 points.
I didn't even know what that means.
Yeah. I didn't know the index went that low.
Yeah.
I didn't
well, retail sales just came out for March, and they were down 8.7%, while the market was looking for an 8. And that'll probably get revised lower still.
Yeah. But let's I want to come back in the next segment and talk a little bit about, sort of what we could read from what markets are telling us and what that means for the for the overall economy.
Right.
We're always saying the markets aren't the economy, but we do get some insights from it. So why don't we take a break and come back on the Macrocast and talk markets and the economy. You're listening to the HPS Macrocast.
Every 2 weeks, HPS measures U.S. adults' feelings and expectations for the economy. The HPS Civic Science Economic Sentiment Index accurately measures movements in overall national economic sentiment and provides a more sophisticated alternative to existing economic sentiment indices. To learn more, contact us through HamiltonPlaceStrategies.com.
All right, we're back on the HPS Macrocast. So we're always fond of saying that the stock market isn't the economy, but we do learn some things from it. I mean, we're getting some signaling from investors. We were at really deep lows just a couple of weeks ago. We went from talking about having the worst week or the worst month since the Great Depression or since the 1974 oil shock, and then now the best month we're having. There's been a pretty strong rebound in equity markets. What do we think investors are seeing that has allowed them to come back? And we should just remember that going down and coming back isn't quite the same thing. They're different things. You've lost a lot along the way. But what are market participants telling us about how they're reading the future right now? What's feeding into this view of a little bit of renewed confidence?
Yeah, I'll let John handle it. But your point that the market isn't the economy is a great one. But the market is trying to predict the future economy.
Mm-hmm.
So it can give very good insights. John, what do you think is going on?
Yeah, and I think that's the key. The markets are trying to look ahead here and trying to look past the peak of infections, past the depths of this second quarter depression-like contraction, and peer into the crystal ball and see what the recovery is going to look like and try to anticipate that. Now, the news over the past week and a half or so, or 2 weeks, have given market participants the ability to hope. And it has, with public health data, has really been the crux of it, with slowing infection rates, flattening out curves in key COVID-19 hotspots like New York City and Italy and some other places. Obviously, these are glimmers of hope. The numbers are still really bad. But as we all know, markets tend to start to rally when things get, the rate of deterioration slows. When things get less worse rather than when they actually get better.
And the big reason why the models are being revised down, predicting less deaths, is because we didn't have a shortage of ventilators and beds so far, knock on wood, in the hotspots. So everyone was able to kind of get what they needed.
It seems like it's weird because of just how fast time is passing. So we're just literally talking. Yeah, we're literally talking about 2 weeks ago, right? So 2 weeks ago, or 3 weeks ago, we didn't know. We heard something about a big, there's going to be a big fiscal plan, and we knew that the Fed was being active. We didn't know how big and what the shape of the $2.2 trillion plan would be, let alone we're already talking about follow-on plans. We didn't know how that money was going to be pushed out. We didn't know all the programs of support that the Fed was doing. They've rolled out, a couple new things just in the past 10 days. On the health stuff that John talked about, I think that's right. Like we were, living with, there was sort of like the central likelihood of what was going to happen. But you also had to account for the worst outcomes of what could happen. I mean, the point was to prepare for the worst in New York, and there seems to be some relief that we didn't have the worst, even if it's really as bad as it was. I mean, I think I saw the numbers now estimated for New York of 10,000 deaths, right? So it's a horrific number for just the state of New York alone, and so very bad. But not as bad as the most aggressive predictions. So
we can argue whether the current level is too optimistic, but I don't think we can argue that the stock market and the bond market should be higher than it was 2 weeks, because the reality on the ground is, thank God, better.
And right. And as Tony, as you said, the second part of what has boosted sentiment to a great extent is that support that came in from both the fiscal and monetary double barrel shotgun blasts that we've seen coming through faster and more forcefully than expected. It's not just the U.S., it's overseas as well. And that has gotten us through. Not only are we, hopefully beginning to see the worst coming behind us in terms of the public health response, we've seen that acute liquidity and panic phase in the markets get past us too, with the help of the Fed and these liquidity injections and a lot of policy support. And so the issue that market participants are grappling with right now is it's certainly, you've got room now to be optimistic about the recovery, but how optimistic should you be? And this is a very thorny problem with no map and historical precedent that really is of any use at all, and trying to understand exactly what this recovery looks like. And you can, from the perspective of we talked about it in the earnings segment, there's going to be a profitability problem. You don't want that to turn into a credit worthiness problem. Obviously, some industries are going to be hit a lot worse than others. But the restarting the economy is not an event; it's a process. And that is, it's a very opaque process. It's one that, you know, we've seen challenge the policymakers in Singapore. You know, even in places like Singapore, where they have great data, great control and translation of public policy into action, and also a very small city state.
It's not a country.
Right, and not the same kind of privacy stuff that we
have.
It's
kind of an island.
Right, it's a big challenge, and you know, coming to grips with that from a market perspective, you know, we get the equity market is bouncing pretty hard, but you look at the treasury market and the 10-year yield has been just frozen deer in the headlights at like 75 basis points. It was down below 70 basis points. You know, oil is we'll talk a little bit about that, but that is definitely giving you some dire signals. We haven't seen in places like in places like China, where they, you know, although, you know, the data has to be taken with a whole shaker of salt, you know, they're supposed to be past the worst of this, and their stock market's dead money. I mean, it's not really going anywhere. And so that we don't have an example right now that we can point to of a really clean, easy, unanimous kind of signal that we're going to have a really easy and positive recovery.
Yeah, I don't want, you know, I think like the market's what it is. It's, you know, millions of participants making decisions every day and taking different sides of their views of the future. So I don't want to read too much into it. And, you know, and I don't like saying that the market got this wrong or they're overshooting. It's just like, from my perspective, I feel like it's almost like a relief rally that, you know, we have this safety net now put in place of economic support. And like, again, like, you know, sentiment and, you know, sentiment is great, but sentiment and, you know, $6 trillion is better. Right. Yeah. Right. So, you know, so like there's like a real reason beyond sentiment. There's a real reason to feel better that the worst has been taken off the table from an economic standpoint. Like the worst outcome has been taken off the table because of the fiscal and monetary support. We have a little bit of better knowledge from health officials. It just every day we learn a little bit more about the expectations for the progress of the virus. All that said, I still, from my perspective, I feel like, you know, that I don't know if there's a good enough understanding. So like we're down 12% from June?
Something like that. Yeah, I think from the highs it's like 15%, which that doesn't sound right.
15%, and I'm thinking we're certainly worse off than 12 to 15%.
Forward, right? Because also from the highs, we were pricing in probably too optimistic view of 2020 before this whole thing.
I'm sorry, in
January, February. Yeah.
I don't know why I keep saying June. Maybe I'm hopeful for June. But when we were at our highs, right? I mean, we thought like, wow, it's kind of, you know, maybe it's like oversold given what GDP was. Because GDP was not going to be great.
Right. We were going to be below 2.
We're looking at 1.7, you know, under 2, below, you know, sub 2% expectations before the coronavirus.
Right.
Yeah. So
that's right. If you're sitting in, I mean, obviously President Trump may have a different view, but basically if you're an economic policymaker in the government and you saw U.S. equities bounce back to almost all-time highs, you'd really be biting your fingernails. That would be very difficult optically for the public to grasp.
Yeah.
And it would seem like an overshoot, and it would, you know, and you'd worry about that relapsing quickly. But you'd also have that, you know, the sense of it is, you know, there is some sort of concern in the market here that, with so much, when you hear market participants talk about why the market is rallying, so many of them talk about these risk parity strategies or a rebalancing. It's very automatic. It's very automated. It's very automatic. A lot of the strategies that we've seen over the last decade come into the markets are taking human agency out of market decisions in the equity market and in other places. And, you know, what you don't want is a perception that the stock market has somehow turned into video poker rather than.
One thing you do have to remember, because this is kind of unprecedented times, you were talking about the treasury market. You know, a 10-year treasury yields 0.7%. The current yield on the S&P is 2.3%, kind of going back to Johnson & Johnson rate. So if you're a longer term investor, you almost, some people have to look at the stocks as a bond almost at this point.
That's a great point. I honestly had not thought about it until you just said that, and that's such an obvious strategy where you'd want to be putting money into equities right now. Yeah. Okay. Well, look. I want to take a break and come back and talk about oil, because this is like to me again. I'm not the smartest guy on oil markets, but so it's a total mystery to me. And I want to hear you guys talk about what we think.
And in normal times, this would be the biggest story that we'd be talking about for markets, and now it's almost something we forget to mention.
Well, let's come back and dive into it. You're listening to the Wednesday, April 15th special bonus edition of the HPS Macrocast.
Markets Policy Partners provides sophisticated financial market analysis that is independent, accessible, and actionable for a broad audience. Learn more at marketspolicy.com or visit them on Twitter @marketspolicy.
All right, we're back with a special bonus HPS Macrocast. Hey guys, President Trump brokering an agreement between the Saudis and the Russians, the other big producers, and there's a belief, and I'm certainly a belief in the White House. They thought they were going to be underpinning price support here, get some rebound in pricing. We're not seeing that. What is going on in oil markets right now? This is what we're in bizarro world where up is down and down is up.
It's certainly, on the face of it, the price action is pretty dispiriting. We had a rally in oil prices, which had sunk both the international benchmark Brent crude and the U.S. benchmark West Texas Intermediate WTI. Both had sunk to nearly 20-year lows at the end of March. And when the White House turned its attention, and President Trump turned his attention specifically on trying to get the Saudis and the Russians back to the table to solve the oil price war that was compounding, which had broken out at the end of February, try to come up with a worse timing for an oil price war between Russia and Saudi. But that's what happened after the OPEC meeting at the end of that month broke down into acrimony.
John, just to be clear, you're saying that a United States president is working with OPEC to make oil prices go up?
Well, it wasn't.
Has that ever happened before?
Well, President Trump has shown himself to be a rather flexible on certain issues, and I think oil prices, once you get past a certain point, it's the cost benefit analysis.
I'm not criticizing President Trump. I'm just pointing out how much the oil has changed in terms of the U.S. economy.
Yeah, and so oil prices had been depressed by this double whammy of an oil price war compounding the organic demand destruction that came along with the pandemic responses around the world. And we were just getting a gigantic glut. Oil prices were down near 2-decade lows, but started a little bit of a rebound as the White House began to broker that deal to fix at least the oil price war. And not only did they resolve the conflict between Russia and Saudi, but last Thursday they managed to broker that basically the two came together to match each other's new output cuts, brought the rest of OPEC along with Russia's not a member of OPEC, so they call it OPEC Plus. So OPEC Plus agreed to 9.7 million barrels per day in cuts over the next 2 months. And following on to that, the Saudis hosted a call with G20 oil ministers, energy ministers, and they had it's not the same as OPEC cuts. It's characterized differently, but they're characterized as basically the organic, not voluntary cuts, but the organic decline in their output would add on to the 10 million barrels per day. There was some hope that this would, put a floor under oil prices, but we're relapsing. The International Energy Agency came out last night with a report basically saying that that demand was now so low that even these pretty heroic cuts in production won't fill the hole. The hopes that storage and putting surplus barrels into storage around the world, not just the U.S. Strategic Petroleum Reserve, but in China and other places might be able to also take some additional supply off the market. President Trump came out and said that this storage, the diversion into storage, plus all these other cuts would take about 20 million barrels per day off the market. But that just doesn't seem credible. The the IEA came out and said that storage looks like it might fill up by mid-year. And right now we've got, their estimates are that supply, even with the cuts, is about 80 million barrels per day. And the usage is at 76 million barrels per day in the second quarter. And that's a really big surplus into a market that was already oversupplied for quite some time. It's awful.
Just an enormous mismatch, and problems of where you're going to be able to put that oil. These are if demand isn't going to come back, it's really even hard to even implement those supply cuts unless they're forced by just lack of storage, don't you think? Eventually you're just going to run out of places to put oil, and then what do? You stop.
Yeah.
You have to stop.
Right. And so they're talking about putting it in train cars, and now the Texas regulators are meeting, so that Texas, which is no friend of OPEC, is talking about having basically statewide output curbs. They're talking with the executives. This is a big shift. They haven't done anything like this for decades, and the decision has yet to be made. But obviously, WTI is not. The U.S. benchmark is underperforming. It's under $20 a barrel right now, and I think that is sending a signal to the Texas regulators that maybe things need, desperate times need to be met with desperate measures. It's really hard for risk assets in general. Like if oil prices are plunging like they are on a day like today, it just is a big red flashing light on the dashboard, and it's hard for investors broadly to get past that kind of signal.
But Tony, it's a good point too, because this is an actual thing that needs to be stored somewhere. Right. It's not, you get stocks and bonds are just, numbers on a computer. This actually has to find a home.
Yeah, it's physical oil. And the reason, look, we have to have some understand that taking oil offline is a pretty big deal. It's a little bit easier today than it was, say 20 years ago, because it's, the way shale is produced. There's a lot of smaller wells that are easier to dial down than it is when you're just talking about big rigs, either offshore or onshore rigs. Those are harder, I know, to shut down, and then there are costs to restart them also. So it's like we shouldn't. I don't want to underestimate just how difficult a challenge that is to just take supply off. And then you always have the question that's always been prevalent in all oil markets is and why the reason why there are these discussions, and the reason why there is an OPEC to begin with is that what if I go and you don't go, right? So the problem with cartels always, what if I shut down and you secretly keep pumping, and you take up that market share given, and as the price comes down, and cheating is the problem with all cartels. And so, that hasn't gone away in this situation either. The other real world impact, in addition to thinking about storing physical oil, is we know state budgets are taking a hit, and federal budgets are taking a hit. They're all taking a hit on the gas tax. The gas tax is still an enormous resource for funding infrastructure in this country. People are very familiar with the U.S. The federal gas tax. They don't know that the state gas taxes are much higher. Make them a much bigger portion of what you pay at the pump for gasoline, and but they're a function of the price of gasoline. It's a percentage. So it gets really hard in a lot of cases. It gets really hard to make up that money when prices of gasoline go down, and then because of the demand shock, nobody's driving. We're all we're forgetting how to drive. Yeah, I mean, no one's going anywhere. So the hit on infrastructure spending or infrastructure resources right now is really, really low. They weren't in a great place. Again, they weren't in a great place to begin with before because gas taxes were probably too low, and so now they're just plummeting. And so states' ability not just to go out and do new infrastructure, but even maintain existing infrastructure is at issue. I think we're going to see in further phases of federal funding, whether it's a phase, the phase 4 or the phase 5, see some additional big infrastructure spending in there. Not even just to deal with the fact that we've got big infrastructure needs in this country, but even just to make up for the fact that we're creating a big hole in expected revenues for infrastructure right now.
Yeah, and there was talk about. It looks like the two sides have come to agreement before they go on recess to top off, especially the small business lending, put another 250 billion, because they'd actually made all the loans basically. That program's going a lot better than I feared. But the Democrats, especially Pelosi, is really fighting for exactly what you were talking about, and at the state and local level. And I just think it's going to happen, whether it's this week or whether it's 2 weeks down the road, that money is going to be allocated from the federal.
Well, we're gonna look more at earnings. I think oil is going to be daily discussion, and we come back on Friday. We're also going to have yet another really ugly weekly initial jobless claims. But I think we're going to begin to see. I mean, this is still the week. The measurement week for jobless claims is still before the CARES Act money started flowing out. I believe still, right? So we're still pre-CARES Act money. So we'll see. We'll see what that looks like in the weeks ahead. I think we're going to start taking a look at whether the CARES Act is having any impact on keeping people going off of unemployment rolls as well. So
that's a great point.
Yeah, we'll see. I mean, again, it's all of this is an inexact science when it says, when we're seeing these big shifts this way. So we'll be learning a lot. But we'll be back on Friday with the regular HPS Macrocast. Have a good Thursday, Wednesday and Thursday, and we'll see you Friday. Stay safe.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share. Find more from Hamilton Place Strategies at hamiltonplacestrategies.com and follow Tony Fratto on Twitter @TonyFratto. Learn more about John Fagan, Brendan Walsh, and the work they do at Markets Policy Partners by visiting marketspolicy.com.